The powers that be would like you to think that it is the Fed chair that has control over inflation. But what's been happening since Nixon took us off the gold standard has been the financialization of America. Every asset now has been turned into a financial trading product for Wall Street. And this should matter to you. So let me show you the truth of why the Fed ain't controlling inflation. Coming up. I'm Lynette Zang, Chief Market Analyst at ITM Trading, a full-service physical, I cannot stress that enough, gold and silver dealer specializing in custom strategies. And wouldn't it have been nice if you realized the government and the central bank strategy back in 1971, and then of course when it was legal to buy physical gold again, you would have loaded up on that in no time if you understood what was happening today. So it's critically important for you to have a plan and a strategy, because I'm going to show you their plan and their strategy right now. So let's just get started. The rising financialization of the U.S. economy. What does that mean? That means that financialization is where Wall Street becomes more important than Main Street. And it is critically important, and the financial crisis in 2008, 7, 8, 9 should have shown you who the government and the central banks think is the most important, because you and I did not get bailed out. It was Wall Street and the banking system that got bailed out. And what happened in the most recent crisis, right? Who really got bailed out? It was not you or me. We've been having to deal with the aftermath of the inflation that they utilize to make things, to paper over things and make things look okay, while in reality what they're really doing and what these financial products really do is transfer that risk from the few, from the 1%, from the powers that be, to the many, to the public. And we are the ones that always pay. Let me show you what I mean. And I've talked about this in previous videos as well. This is the financial services sector controls a widening swath of the U.S. economy. And here it is. This is going back to 1940, where it was a little bit more than 10%. Well, now it's closer to 25%, or at least in 2020, it would be higher than that today, 3 years later. And that 25% actually controls much more of the GDP in the global economy. U.S. Bureau of Economic Analysis data show that financial sector profits and their share of GDP have skyrocketed since the 1970s. What happened in the 1970s? Our government handed over full control of inflation to a private bank, the Federal Reserve. Well, who benefits? Because since then, everything has been turned into a financial product, because it is so critically important that the banks make their profit. Not how you and I and the prices that you and I pay, but the banks make their profit. And so they created derivatives. Now look, derivatives, speculative derivatives. Derivatives have been around for a long time. If I were a farmer and I'm planting my crops in the spring and I'm not going to be able to harvest them until the fall, I have no idea what the weather conditions are going to be, what the water conditions are going to be, if I'm going to recoup my costs from planting this crop and all the costs associated with it. If I'm going to make a profit, am I going to be able to stay around? So a derivative for a farmer ensures, it's an insurance contract, right? He can buy or she can buy a derivative contract that ensures that their corn or their soy or whatever they're growing, that they at least break even so they can live for another day. If they don't need it, okay, it goes away. It's just the cost of insurance. But if they do need it, it can save their lives. Rather, what's happened, because this, thank you, this green line, those are end user contracts. So you can see they've kind of stayed pretty stable. But these are the speculative derivative contracts. There's 2008. So you can see quite clearly that they're higher than they were during the crisis because the banks have to make a profit. And the more trading products that there are, and I mean, we've witnessed through many means, cryptocurrencies for one, how do you create a market? You start getting eyes on it and you start trading it, and before you know it, here's a new asset class. Okay, out of thin air. And that's how they do it. But what it does is it ensures their profits. In fact, this is from the most current Office of the Comptroller of the Currency derivatives in the FDIC insured banks. And we can see that this is 50% right there. That red line, that's 50%. So banks actually this past quarter generated over 51.7% of their profits from trading these speculative derivatives. And it's taken more and more speculation to generate these profits. And so what is that really telling you? That there is a lot more risk in the banking system. And since 2013, they created these different products to consolidate the trades. And so every single entity, whether it's the FDIC, the Federal Reserve, the Bank for International Settlements, any of them, admit openly that no one really knows the true value at risk. When you're looking at these charts and graphs, all you're really seeing is the market, the current market valuation of these contracts, which are all counterparty risk. What financial asset does not run counterparty risk? According to the Bank for International Settlements, gold is the only financial asset, not one of two or three or four or five, the only financial asset that does not run counterparty risk. And I think that is really significant. And I want to talk to you about oil, because when oil was rising so rapidly, we saw it, the consumers saw it at the gas pumps. And that was scaring a lot of people that were having trouble putting food on the table and gas in their tanks. So look, oil's wild ride, does that really indicate a true supply and demand market? Of course it doesn't. Oil's wild ride is driven by a disruptive band of bot traders. What's a bot? A bot is an algorithm. An opaque group of algorithmic money managers have seized control of the oil market. These guys have seized control of all of the markets. But let's just look at that a little bit deeper. This year's volatile price swings are being intensified by these bots, according to interviews with more than a dozen traders, analysts, and money managers who work in the oil market. They've roiled commodities from gasoline to gold, sidelined traditional investors, drawn the ire of OPEC, and even raised eyebrows at the White House. But the reality is, and what they're also saying in here, is that traders are the ones that are determining the prices of all of these commodities and assets that you're buying. And so do you think that might have a little bit to do with inflation? And when inflation was obviously running rampant and the prices at the gas pump were obviously going up, how did that make consumers feel? And 70% of our GDP, that's all the money that flows through the system, is consumer spending. This is frankly a very big deal. This is an opaque. These markets are opaque, admittedly so. And especially to you and me, well, not me because I do pay attention to this, but to most people that don't pay attention. They don't even know where to look. They don't even know how to pay attention. Why isn't that more open? Why does it have to be this opaque? And how does that impact you and me? That's why you don't see a crisis until it occurs. And then it's too late to do anything about it. And what they said was this, I'm just going to repeat it, this opaque group of algorithmic money managers have roiled commodities from gasoline to gold. Well, good. I mean, don't we all want computers to be determining everything? And this entity is known as commodity trading advisors. So it's not one entity, it's a group of entities. So let's take a look at that a little bit closer. And I wanted to give you that name. If you need it, write it down. Go into the blog. You can find all of these slides on the blog and certainly all of the links. But almost 60% of managed money positions where CTAs, remember, commodity trading advisors, that's CTAs, were over 90% engaged. So that's almost 60% of the trading market. That's huge. Algorithmic trading for oil, we're just talking about oil here, 2023 spike. Look at this. This is who's controlling everything. CTAs are loosely labeled as an individual or organization that advises on the trading of futures, options, or swaps. Those are all derivatives, by the way. Arose by any other name is still the same. But those in the know say that most are defined by their trading strategies, computer-driven and rules-based with relatively limited time horizons. So that means that there isn't anybody to put the brakes on. These are all algorithms, and they're just going to move based upon whatever is happening in the market at that moment in time. But this is also what creates all of the whipsaw volatility, and not just that we've seen in the oil markets, but also in the treasury markets. And the treasury markets are the flippin' foundation of the global financial system. How does that make you feel? Because it makes me feel awful. It scares me. This is why I'm in gold. I don't want to be in those markets where they're the ones that are controlling everything. I want to hold it. I want to own it outright. I want it to be invisible. I want to always have access to it. But just so you can see how this has grown, right? Energy CTAs up 3 times from 2021 to 2023. This is December of 2021 to July of 2023. A year, what is that, a year and a half? Year and a half. Up 3 times. Up 4 times. This is just the top 3. Up 4 times. As my grandson would say. I mean, do you get that there are bots, just computer algorithms that are trading these markets that you put your hard-earned money into through your 401k, through your annuity, variable annuity, through your IRAs when you buy mutual funds or ETFs or any of these managed products. And these are traded by algorithms, not humans. And this is really quite critical because algorithms don't care about anything other than the formulas that are put in. That makes me, to be honest with you, a bit uncomfortable, to say the least, because these are completely opaque. Opaque. That's why I always tell you, I would rather be 2 weeks, 10 years too early. I don't care how early I am, but I don't even want to be 1 second too late. So too many people think that they're going to magically know and have the time, ability, and money to get prepared. Well, you don't. And if you go back to 2008 in September when Lehman failed, did you know that was going to happen? Or were you shocked? Because I was paying very close attention. Lehman's my alma mater. And I couldn't have told you 5 minutes before it actually happened that I would have believed that what happened could have happened. And I don't think, well, there are certainly people that pay more attention to the markets than I do, I'm sure. But most normal people do not, for sure. So the time to get prepared is now, while we still have the time and the opportunity and availability, because this market is drying up pretty quickly, especially when we see the breakout that recently happened in the spot gold contracts. Well, what about something that's an absolute necessity for you and I to have, which is water? We can live without oil. We can walk. We can ride horses. We can ride bicycles. But can we live without water? No, we cannot. If you do not have water, you die. And well, let's see, when was this? Oh, 8/20/20, 8/21 of 2020. So a little bit more than 3 years ago, the U.S. regulator welcomes a water futures as a tool to manage climate risk. Do you really want to be controlled by these opaque computers and those that make the rules and the laws? This is why, here's the motto. You guys have heard it a gazillion times. You'll hear it again. Food, water, energy, security, barterability, wealth preservation, community, and shelter. Get it done, because you cannot live without water. So now that that's been turned into a trading asset, what do you think the impact of that is? Well, let's just keep reading this. The CME, which operates the Chicago Futures Exchange, last week said that it would begin trading the world's first future contracts for water tied to prices in, of all places, California. Well, you know, we've already had the experience with Enron and other entities on how California, particularly, their energy, their rights have been traded away. But the contracts are a really good thing. Yeah. Water derivatives and other investment products linked to environmental, social, and governance factors will help stakeholders. Who's a stakeholder? Oh, those are deep pockets. They're the stakeholders, not you or me. Help stakeholders manage the risk that is going to continue to present itself to us. Oh, so it's supposed to be a good thing for you and me, is it? I don't think so. Here we are, April 11th, 2023. So not even 3 years later, Groundwater Goldrush. What a shocker. I mean, seriously, banks, pension funds, and insurers have been turning to California's scarce water into enormous profits, leaving people with less to drink. Yeah. Isn't that interesting? That just not even 3 short years after this was turned into a financial trading product that was supposed to be a good thing for stakeholders to manage risk, now who's really at risk? You and I are. If we are completely dependent upon the normal water supply, we're in trouble. What have you done to ensure that you always have water to drink and water to grow food with and clean yourselves with and all the other very important things that water provides for us, the ability to live? Because here's the truth. Deeper pockets, deeper wells, that's what's basically going on here. Whoever is doing this doesn't give a damn about the small people. Well, it's traders. They don't give a damn about that. They only care about profits. Last year, almost 1,500 domestic wells went dry statewide, and the state auditor reported almost 1 million Californians had no safe drinking water in their homes. Today, the people of Woodville drink bottled water. So whatever you have pumped to your home is going to cost you more, and now you have to go out and buy water. Now, I know a lot of people do buy water. That creates some other things as well. But my point here is everything has been turned into a financial product, and it's all controlled by traders. So that creates a problem for the central banks that are raising or lowering rates in an attempt to control inflation, because what they're really depending upon is a true supply and demand market. But what they're really playing with is Wall Street and that derivatives market, which again, everybody admits, every single governing entity admits that nobody knows the true value at risk. I'm going back to this one for a second. Nobody knows the true value at risk in these speculative derivatives in which banks and this is just banks, so it's different for Wall Street firms. Banks make 51.7%, at least in last quarter. Sometimes it was closer to 100% in trading revenue, in all of their revenues. Don't you think that's kind of significant? Who's more important, you or Wall Street? Well, financialization is when Wall Street becomes far more important than Main Street, and Wall Street has won. And this is another big reason why the whole system has to reset. Because we're at the end. They've gotten everything, or they're about to get everything they can out of us. We're going to a hyperinflationary depression and convert into a new system. And this is why community is so important. Because if we stand alone, there's not one thing we can do against these entities. They're too powerful. But if we come together, there are more of us than there are of them, and we have more pocketbooks than they do. They have leverage, we have pocketbooks. And how do you stand against them? This is how you do it. You take your wealth out of the system and you put it in something that is real, like real money, that is used in every single sector of the global economy. So there is always real demand, not the fake demand that all of these trading contracts create and the leverage that they create. You hold it, you own it outright. Let me show you just, a few examples. And understand, everything has been turned into this. This is from the CME Group. The world's benchmark commodity products all in one place. We're going to make it so easy to trade. Engage in multi-commodity strategies with one connection, one clearinghouse, and one window to the world's most liquid physical futures and options markets. Physical, meaning oil, gold, lumber, steel, food, energy, physical assets that have been turned into trading contract. And since it's cheap and it's almost free, it's cheap and it's nothing to move in and out of these contracts, they don't care about the ultimate outcome. They don't even really care about yours or my short-term outcome. They only care about picking up some profits. And here's an example of some of those commodities. In the energy space, and we all use energy. You got crude oil, you've got natural gas, you've got West Texas oil, so processed oil. And in food, corn, soybeans, soy oil, wheat. But it's also in sugar and cacao and coffee and everything, olive oil, everything. In anything that is a tangible assets. And it's really the traders that control the consumer pricing. They can drive those prices up. They can drive them down. Don't you remember, what was it, during the pandemic when we had minus? I was going to pay you, a trader would pay you $35 for a barrel of oil. Minus. So don't be fooled by this lie. Here's another one, which is metals contracts. Okay, so what do we have? We have gold, we have silver, we have, those are the two that I'm going to show you, but it's also copper, platinum, palladium, everything. Everything. We are at the end. Everything has been commoditized. Everything has been financialized. It has all been changed into a trading product. And what you're looking at is you've seen this graph like lots of times, from the Office of the OCC. Yeah. And this is gold contracts, notional amounts of gold contracts. And you can see how they spiked because they changed some accounting rules. But do you think that this could suppress the price and manage the price? And the difference between these colors are the length of the contract. But it doesn't really matter how long the contract is. Not like you have to sit, or the traders have to sit and hold them. All they really want to do is a pickup. They only care about the profits. And also, I will remind you that we just recently had a breakout from a triple top. I've talked about this. You can refer back to the work that I've done on what's happening in the gold market since December 5th. This is a very big deal. And what this really tells me is that traders see some of the writing on the wall, and they are buying gold and overwhelming the Fed's ability to keep that price suppressed. Which camp do you want to be in? You have to decide for yourself. Do you want the traders to control your wealth? And they're all overvalued because of that, because it really doesn't matter. And this era of cheap money is over, at least for now. Or do you want to control it? This puts you at the driver's seat. Why do you think they had to take gold out of the money system to begin with? Because when we were on a gold standard, if you did not like what the governments were doing, you simply walked into the bank with, a $20 bill. I've got one, but you walked in for a $20 bill and you walked out with an ounce of gold. Well, that created restrictions around what the government could do. They did not like it. Plus, corporations wanted to pay you less and less. Well, on a gold standard, that really didn't happen. I'm not saying there wasn't an ebb and flow, but it was simply an ebb and flow. So they had to convert us to the fiat money system, which is just, their ability to print all that garbage, right? And control the value of what they were printing and take gold out of the system so governments had no limitations on the level of debt that they could grow, which certainly we're at a peak. It's a big concern, but also the ability of corporations to pay you less and less because nominally it looks like you're making more. But in reality, because inflation has robbed you of your purchasing power, there is actually less and less value in these things. In fact, officially 3 cents. What happens when you get to zero? They tested negative rates. That's what the CBDCs will enable the central banks to do. They tell us that. Once we have CBDCs, there are no limits on how low we can push interest rates. And they will, because they have to take and attack your principal. That's what negative rates do. They get all the purchasing power, your principal's next. How do you fight that? This is how you fight that. It's so simple. Look at what the central banks are doing for themselves. They're buying gold hand over fist so that at the other side of this mess, they retain choices, retain their freedom, and retain control. Same exact reason why you and I do it. Now, make sure that you watch the last video that we did, which is interest on the debt bubble. Because once you have that going up like a hockey stick, there ain't no getting out of debt. You have to hyperinflate it away. Also, we have a great desk, which I know many of you are participating in. I'm so happy between Daniela Cambone and Taylor Kenny and me. I think we've got you covered in every single area, whether it's interviews, deep dives, or 101s. We want you to have the ability to make educated choices that puts your best interests first. What a concept. So if you haven't done it yet, click that Calendly link below. Get your strategy not just set up, get it executed. We only have as much time as we have. And I can't tell you the exact moment that you're going to lose those choices, but I can tell you, I can give you this guarantee. We will come a time where you will lose those choices. So make it while you can, while it's still severely undervalued and you actually have some choices left. And if you like this, please give us a thumbs up. Make sure that you subscribe, leave us a comment. And remember, this is your wealth shield, physical, in your possession. Because if you don't hold it, you don't own it. And until next we meet, please be safe out there. Bye-bye.